what I like to start with is financial metrics. So, I'm going to run this on all your deals, Nancy. Basically, I look at, current year to date, annualize it prior year, and then look at industry. And the red flags that come up are generally, where are the outliers? Are margins, unusually high? Is debt high? Are assets on the balance sheet unusually high? So if I'm dealing with a manufacturer, inventory is always a big question mark. Does it look reasonable or not? And sometimes it gives me a lot of comfort because I can tell a lot of times from the balance sheet if a seller is just tax motivated and has written everything off, or if they're being aggressive. And I guess the main lesson that I've learned over the years in dealing with various buy side situations is it really doesn't matter to what degree they've had work done on their financials. I've gone into situations where an audit was done by a Big Four accounting firm and basically cut the net income in half, from the adjustments that I found. So it doesn't matter. I also deal, though, with the other end of the spectrum where basically you have a tax return at the end of the year, all the records are cash basis, and pull that together, into a meaningful conclusion for my clients. So that's kind of the initial approach. And as I said, Nancy, as I go through your deals, I'm going to look at that. So those are what I consider kind of the red flags initially. But from there, I would construct a specific program. So in other words, if inventory looks like a risky area, well, are they a manufacturer? And if so, how are they doing their cost accounting? What kind of controls do they have over inventory? What are their perpetual records like? Do they have job costing records? Do they track labor? Those types of questions that enable me, because how I characterize diligence is a probing. It's not like you go in expecting to look at everything. It's more like I'm probing for areas that cave in. In other words, I'll put my finger, and if it falls through the wall, that's the area that I want to look very hard at. That's how I characterize it, because you just don't have time to look at everything, and no one has the budget to spend on that type of thing. It is more of a probing exercise, and when you find something, well, then that turns into the findings, and potentially, and when you have findings, which inevitably I do, I'd say 98% of the time, I'll have significant findings on the due diligence that I do. And what happens as a result can vary. One is maybe the buyer's already built in, a certain amount of tolerance for adjustments. So that's one situation. However, even in those situations, when other negotiations come up, it's good to have these items in your back pocket. In other words, these can come in handy. At the other extreme, I've had people in transactions where the changes that I found are so extreme that it's led to a withdrawal from the deal or a renegotiation, and the withdrawal may be pending redoing the records. And I'm almost on the verge of doing that right now on a deal I'm working on, because it doesn't appear, it appears that the sellers maintain records, but they don't appear to be supportable. They've done things in QuickBooks that are kind of odd, and I think they plug their balance sheet and they try to support a P&L. So in other words, the records don't hold together. And it's very unusual to see a situation like that, because usually when people are doing accounting, it is double entry, but in this case, it doesn't appear to be. So it may lead to more accounting work. And then that would normally we'd want to transfer to the seller. You wouldn't want to pay for that. So that's kind of the approach. And again, this is all off the top of my head here. I'm not presenting anything, but I'd say that those are the main issues